Interest rates. They impact every corner of the economy, yet figuring out where they're going is kind of like solving a Rubik's Cube. I'm Ed D'Agostino, and in today's Global Macro Update, I speak with Barry Habib, founder and CEO of MBS Highway. We talk interest rates, zombie companies, and the future of housing in America. I want to toss you a curveball today. You know, I always think of you when I think about rates and certainly about housing and mortgages. But because you're so good on rates, I want to talk to you about zombie companies. We've had some bankruptcies this year. This week, we found out that one of the largest trucking companies in the country, Yellow Freight, going under. And they kind of have that profile of the zombie company, right? So a company that is able to service its debt. They make just enough money to service their debt, but they can't pay it off. And they're really sensitive to economic shocks or interest rates. My question for you is, are rates starting to bite? Are you starting to see the impact of such higher interest rates moving up so quickly? What are you seeing?
You're 100% right. Unfortunately, the Fed's looking to do things until something breaks, and we're starting to see things break. We saw it in banking. We saw that in March. And now Yellow, the third largest trucking company, they received, if I'm not mistaken, approximately $700 million in some COVID relief money. And they were able to service their debt, just like you say. But as debt rolls over, because we know that when you take out debt on the commercial side, it's not as if it's a mortgage, 30-year fixed rates. You're going to have short time frames before that adjusts, and it's not going to adjust with caps. So you're going to go to the market rate. And if you think about the typical benchmarks, it's SOFR, which that SOFR is going to reflect the Fed funds rate on perhaps a 30-day delay. And then they're going to put a healthy margin on top of that, 400, 500, 600 basis points. That's going to have adjusted maybe from the last time that they were looking at it by a very significant amount. Perhaps it's 400 basis points, 500 basis points. And on large sums of money, large sums of debt that has to be serviced, all of a sudden things don't pencil in. And if you don't have the upside pricing pressure to make that up, well, then you find yourself in a tough situation. Let's hope this doesn't continue. But my fear is that this is going to bite, as you said, and it is already biting. And you're going to continue to see situations like this manifest themselves. And I think that these are the unintended consequences of the Fed first putting us in this position and then trying to adjust for it too quickly and too much. You know, one of the things that we can look at is we could look at Christine Lagarde and the ECB. Now, their equivalent of our Fed funds rate is much less, about 150 basis points less at 3.75. However, their inflation is actually higher than ours. But they see the tide turning. And what they're doing is they're looking forward instead of looking backward. And they're saying, hey, you know what? It takes time, as Christine Lagarde said, not in so many words, but for these rate increases to filter through and bite. So I think they're being wise in taking a more, let's go easy here and let's see what the results of these actions that we've taken, whereas Jerome Powell and our current members of the Fed are, in my humble opinion, really looking through the rearview mirror. I mean, that's what got us into this. And I think they continue to make that mistake. Now, by the way, you were so kind saying I'm so good on rates. We've had some good calls, but the most recent one was incorrect. You know, let's get that out on the table, take full responsibility. I thought mortgage rates would have been lower. They have not come down. I still think they will come down. They typically tend to follow inflation. Now, we were right on inflation. Inflation has done what we thought, but we haven't seen the corresponding move yet, at least on mortgage rates. So we didn't get that one correct, but thank you.
It's funny, this zombie company phenomenon. I went back and looked at the Federal Reserve did a report back in, I think it was July of 2021 on zombie companies. How big of an issue is it? And what they found was that zombie companies tend to bounce somewhere between a low of 6% and a high of almost 15% of all U.S. public companies are classified as zombies. So right now, they think we're around 10%. So if you think about 10% of U.S. publicly traded companies potentially going under because of higher rates. One, that's shocking. Two, that's a lot of people that are going to lose their jobs, and you have to wonder if they're all going to be able to be absorbed, like the 30,000 people from Yellow. And then three, the most ironic part, it could be inflationary, right? I mean, who gets wiped out in this scenario? The low-cost providers, the companies that are competing just on price. If they get flushed out, now prices can go up even more, which puts more pressure on inflation. It's so complicated and circular.
It's a Rubik's Cube, like you said, because by them going out, it certainly will create more people that are unemployed, unfortunately. But by the same token, in a less competitive environment with less competitors, it does allow for some pricing pressure. There's going to be limits on that, but there is going to be some pricing pressures that they may have more room for, and that could in some way be inflationary. There's going to be counterbalances to that inflationary pressure by greater unemployment, less demand. Slower demand will probably keep that to some degree at bay. But you're right. It is interesting in that when you turn one thing one way, it has so many different compounding effects. A big one, Ed, with regards to now that you bring up inflation is, we have kind of moved in the right direction on inflation. It's not going to be as fast. The big move lower has occurred, but right now we are probably going to see a little bit of a slower amount of progress. The thing that we have to look out for is in a couple of weeks, we're going to get the CPI report for July. And my feeling is that this will be to some degree misinterpreted. The year-over-year inflation reading has a likelihood of going up. You heard me right. The year-over-year inflation, after coming down, if you take a look at where CPI was, 9.1% June of 2022, and that's come all the way down to 3%, right? So that's made a very, very good amount of progress. But if you look at the reading from July of 2022, it was actually a negative month-over-month print. So when you look at the comparison, the July of 2023, which will replace the July of 2022, it'll be tough to get a negative print, especially in July, seeing oil prices rise the amount that they've risen. So it's quite likely that the year-over-year inflation reading will go from 3% to a number slightly above that. And then people misinterpret, it's like the late 70s, early 80s again, where inflation took a dip, then it's going to come roaring back. That's not the case. That's not going to happen. It's a 1-month occurrence, but I fear the markets will misinterpret it, and I fear that our Fed will also misinterpret it.
And so that would mean more rate hikes, you think?
Well, the next Fed meeting is September 20th, so they will have a little bit more to go on. And it's such a shame because, shelter plays an enormous role in this. And there's something that I'd like to bring up, which perhaps illustrates this kind of well as to where we are in shelter. And I'm going to bring up a chart right here just to show you. So let me pull this up here so we could see it. And when you take a look at shelter and you take into account the impact it has on both CPI and PCE, personal consumption expenditure. Those are the two big inflation readings that we get, the way we measure inflation. Now, the Fed has been a bit confusing in what they want to really focus on. Now, it's true they need to focus on everything, but first they said, well, something like headline inflation or headline CPI, that's what they want to focus on because that's what the consumer feels. It includes food and includes energy, and that really goes to the heart of what the consumer feels. But then they kind of came off of that and they went to this, now we want to look at super core. So let's remove food, energy, and shelter. And in the last 3 months, if you take a look at an annualized basis, it's like 1.4%. So that's come way down. But they've come off of that again. And they said, let's go to core PCE, which removes food and energy, and it's based on the personal consumption expenditure. So they have been changing the goalposts around, I think, so that the narrative will allow them a green light to continue with hiking rates and justify why they've been hiking rates. So they've been moving this around quite a bit. But if we take a look at the core readings, now this removes food and energy, and the core PCE is the big one that they want to look at. 21% of it, around there, is shelter. And 43.5%, of course, CPI is shelter. So shelter has a very big weighting. Now, people do get confused here. They think that shelter would include price of homes. I hear people making that mistake. It doesn't. That was a change that was made in the 70s, by the Carter administration. As how do we get inflation to come down and look better, right? So they kind of went off of that and they made it more towards rent. So it's rent and owner's equivalent rent, which makes up the vast majority of shelter costs. And owner's equivalent rent is a bit of a guessing game where owners are asked how much they could rent their own home for. But what's really fascinating about this, and I've studied this for a very long time, for whatever reason, they tend to track very closely with actual rents. So it's a pretty good number. And when we look at actual rents, they are on a year-over-year basis going up at 3.4%. And you can see how much they have come down here in this chart. So they have dropped down dramatically. But and by the way, this includes new rents and renewal rents. But because what it looks at is the last 12 months, you're going to average all this in. And worse yet, if somebody were asked what they're paying rent here, it could reflect the lease that was signed even further back. So there is a long lag here. And when we take a look at the way that it is currently reported within the inflation readings of both CPI or PCE, it's around 7.8% in these readings. So there's a very big difference between what the Fed looks at to see their target on inflation and what's really happening when you're looking through the front window or in real time. Now, you could do a mathematical calculation between these two, say, okay, what's the difference in the two interest rates of increase, and then multiply it by the weighting. And when you do, here's what you come up with. So core CPI peaked in September. Now, remember that the headline numbers of these peaked in June of 2022, but these peaked in September of 2022, and these were the peak readings. So we just got the numbers for June, and that showed that these numbers have come down quite a bit. Core PCE down to 4.1. That's a good number, but the Fed wants 2%. Now, when we take this lag effect and you take 7.8 minus 3.4 and multiply it by the corresponding readings, this is what the real inflation numbers are. And that's what's happening in real time. It's very close to the trueflation numbers, which are about 2.4%. So this is giving us where we are, but the Fed's ignoring this. And by the Fed ignoring this, unfortunately, they're going to press too far. You're going to get these zombie companies, you're going to get these banking situations, and you're going to probably see it start to impact the labor market. And it's simply because the Fed doesn't understand this or refuses to understand this. And look, they got us here. Okay, the Fed should have stopped back here. This would have been the answer for them. This was the QE period in the middle of 2021. They should have stopped when inflation was going up, but they ignored it. And the reason was the same thing. Here's where we are currently, right? But let's go back real quick to 2021. When they looked at the inflation readings, they said, we don't have to worry about inflation because we're looking at shelter, these big weightings of shelter. It was only showing 2.5% year over year, which was holding inflation down. But what was happening with shelter in real time, they were skyrocketing. They were going up at 7.5% year over year on their way to higher numbers. If they would have taken this into consideration, what they would have done at that time is they would have said, hey, we need to put ourselves in a position where we stop QE, where we start to allow the market to adjust, maybe with some small rate hikes early on, and we would have not had these problems that we're experiencing now.
You mentioned the Rubik's Cube before. I want to touch on a whole bunch of different factors that might affect housing pricing and rates. First would be multifamily. There's a purported wave of multifamily units under construction, right? A lot of apartments under construction that are going to hit the market kind of all at once. What's that going to do?
I hear a lot about this, Ed, and while it is true, there's two things that we have to understand about it. Number one, we're already extraordinarily short. And when these apartments are completed, they're not going to be distributed evenly everywhere. So there's where the biggest need is, where we're very short. So it really isn't going to turn the tide dramatically. And perhaps more importantly than that, it will not continue beyond these. These are currently under construction. There is a dearth of new ones coming to the marketplace. So when we look at overall how many units are going to be built, this includes multifamily. These are dwellings, not individual structures. So how many individual families can go into a unit? It is going to be in the range of about 1.4 million. But what we also need to understand is that about 100 to 200,000 units each year get retired due to aging, so they get replaced. So we are netting, let's call it 1.3 million new units. Now, the most recent number that we have for households being formed at the same time is about 1.5 million. Interestingly enough, in 2 days, we will get the more recent number for the amount of household formations. I'm going to assume it'll probably be in the range of 1.5 million. But if you're forming 1.5 million households and you're only netting coming to market with 1.3 to put them in, there continues to be a shortage of housing that we're looking at. So this is a problem that I don't think is going away very quickly.
So you still maintain that housing prices are going to hold. They're not going to come down.
I do. And this is an area I'm proud of that we've got it right. And we try and simplify it. Housing is two stories here. You have the story of housing as a driver of economic activity, and that is clearly in recession. That's slowed down. We're not seeing activity. But then there's housing, the investment. I'm going to buy a home. Is it safe? Will there be a collapse like there was in 2006, 2007, 2008, 2009? That range of where we saw prices really rise and then come back down. That is a different story. That there's a lot of strength there. There's overwhelming demand. So here's what we've got. We've got the pool of demand has shrunk for sure. Affordability, although affordability is improving as incomes go up. And remember, you don't use all of your income for the mortgage payment. So you don't have to keep up with it exactly. If you're using 20% or 25% of your monthly income, if your income goes up 5%, you can handle a multiple of that. 20% in mortgage payment increase. So it's interesting the way it works. But affordability is catching up as incomes continue to rise. And what you're seeing is there's less demand because of that. There's less available pool of buyers. But even that shrunk pool of available buyers still overwhelms the even greater shrinkage in available inventory. So it comes down to the first thing we learned in economics is just more demand than supply, which are supporting home values. We see home values this year up 6%. That was our forecast at the beginning of the year when you and I talked. I think we're going to come in light on that. I think we're probably going to see that a little bit above 6% this year. So, wow. and into the future years, it's hard to see a big downward move, especially if rates are more cooperative. If inflation does what it's supposed to do, comes down, and I think it will continue to come down. Next month, as I said, it's a bump, but then you'll see slow progress, but certainly in the right direction, helped by that shelter catching up. You probably will see demand increase rather significantly, and there's just not enough supply out there. So I think home values will be healthy, will be strong.
Which just adds to the inaffordability for a lot of people when you take rates into account.
Yes.
So let's talk about rates, right? So that's the other side of the affordability equation. It seems like there's a lot of things that are going to keep rates high. I mean, first, you've got the Fed really committed to getting inflation down to their 2% target, which is proving tough. You've got kind of weird things. Again, the Rubik's Cube. You've got Japan easing up on its yield curve control, and all of a sudden interest rates spike in the United States. Who is not in finance or economics would have even seen that coming? Does that affect mortgages, and to what extent?
You're 100% correct. They all do. So let's address those one at a time. But I just want to rewind just for a moment here to talk about just a couple of quick things on housing that I should have mentioned. Something that can be confusing is median home price. So median home price, the media oftentimes gets this wrong. And they say, well, median home price drops, so therefore home values are declining. They're two different things. If we remember in math class, median is just the middle number in a series of numbers from lowest to highest. So to take a simple example here, say there's 5 homes from lowest to highest that sold. The middle priced one is the median home price in that series. So a year later, if home values like they did last year appreciated 6%, let's say it applied to all these homes, all the home values went up. But if in the following year, just 3 homes sell and they happen to be the lower 3 priced homes, well, then the median home price would have dropped while there is appreciation. So we just have to bear that in mind. It's an important thing that the media oftentimes misinterprets. So we are seeing home price appreciation. We'll probably continue to see that. With respect to how interest rates affect that, yeah, interest rates always have a major bearing, and there's a lot of factors on interest rates. We know inflation is a huge one. But in addition to inflation, what you also have to look at is the Fed. And the Fed now, with a Fed funds rate in a target range between 5.25%, 5.5%, call it 5 3/8 or 5.39%, that's going to add upside pressure to mortgage rates, because while the 10-year Treasury is trading beneath that level, the spread of mortgages typically is about 2% over the 10-year Treasury. But part of the value of a mortgage is servicing value. And the servicers don't think that 7% is going to last forever. So they're not paying up. People aren't paying for servicing rights because it takes time to get your money back on the monthly amount of money you receive by collecting people's mortgage payments, paying the taxes, paying the insurance, doing the servicing tasks that would give you that fee. So therefore, the value of a mortgage has shrunk because it's estimated that these loans will pay off sooner. So that's causing the spread to rise. But also duration has changed. Instead of people saying, the duration is similar to a 10-year Treasury, not at 7% mortgages, maybe the duration is closer to a 2-year Treasury. So we're seeing about a 2% ride above, more like the 2-year Treasury than the 10-year Treasury. I think what will be really important, Ed, is if we reach a point where inflation is convincingly lower, if the Fed starts to say, hey, we need to back off because we've broken something. What could cause that? A couple of bad job numbers, some improving inflation. And we could get a bad jobs number. We really could. I don't think the labor market is quite as strong as people think it is. Last month in the jobs number, we saw if you looked at the household survey, 270,000 job creations, 452,000 were part-time. That means we lost 180,000 full-time workers. And there were some similar weaknesses in the business survey as well. We're still adding jobs from this birth-death ratio, which is terrible at getting inflection points. Now, you mentioned Japan. And we had this situation when Japan went a few months back. You probably recall we went from yield curve control being from 0 to 1/4, and they raised it from 1/4 to 1/2. And we had a temporary blip up in our 10-year Treasury and mortgage rates, but then it kind of evened out. So it was absorbed. And now here we are. They went from, okay, we're taking yield curve control off 50 basis points and going up to 100. But once it hit 60 basis points, the Bank of Japan already intervened and started buying. So believe it or not, the market took some solace in that. And we have 10-year Treasury yields in the face of, just seeing Japan hike, improve a little bit, and mortgage rates slightly, but improving today as well.
And the reason why Japan's changes in how they treat their bonds can affect us for the layman who's watching and trying to figure this out. Can you explain briefly why that is?
All yields are interconnected in that they do compete for money, and you'll see as yields rise in one part of the globe of a major financial power like Japan, like Europe, you will see sympathy and yields rise in other places as well, as they're all kind of competing with each other. As yields rise, people can go to different places to get a greater yield. Now, it gets deeper than that because it's not just the yield that you're competing for. You're kind of thinking in advance and you're saying, hey, if they're raising their yield, if I buy some of those bonds, even if they offer a lower yield, if they're going to be continuing to increase yield, then I should probably invest in the currency, because then that currency will do well. So I'll make a little bit of money on the yield, but I'll make a lot of money on the currency. So that's how these things tend to work. It is it is truly, to use the word Rubik's Cube. Yeah, that's one thing that's once you start getting into currencies, this is certainly complicated. But what the bottom line is that when you talk about Great Britain, talk about Japan, you talk about the United States, you talk about the European Union, rates tend to, not in lockstep, but directionally have sympathy in the way they move up or down.
So a couple other things, Barry. because I can't resist asking you questions about housing while I've got Barry
Yeah,
Habib
for
on with
sure.
me. Baby boomers downsizing. That is a trend that I'm hearing about more and more and reading about. So boomers selling their 3,000, 4,000, 5,000 square foot McMansions or whatever you want to call them, and trading down into, say, a 2,000 or 2,500 square foot cheaper house. They make more money when they sell. They reinvest some of it, put some money in the bank. They've got a smaller home. Life is easier. But who is being impacted in certain pockets of the country are the first time home buyers who normally would be buying that 2,000 square foot house. And now they have to compete with these cash rich buyers. Is that something you're seeing nationally?
Seeing and feeling it, it's great insight. So you probably know this. I've got a big house in Jersey still, and I've got a couple of units here in Florida, which are nice, pretty condos that I live in. I come to Florida and I just turn up, unlock the door, and it's all set. I go back to Jersey, and that house has a punch list of things that need to get done. So I imagine I'm not the only one who's experiencing this. And after a while, you're like, man, maybe it's just a good idea to do exactly what you said and just downsize to something that's a little bit more convenient. I'm a baby boomer, so I would imagine that that's being experienced. But what's happening is interesting on the other end as well, because you're having that influx of individuals now hitting their stride in their 30s where they do want to purchase that bigger home too. So whether they take over the home that the baby boom is downsizing is one thing, or whether they're on a smaller scale competing with the downsize from the baby boomer, that's kind of hard to gauge. And I think a lot of that depends on regionally or locally what's going on. But I think that some of it's being absorbed on the upper end, and I think that some of it is being more competition on the lower end. And once again, there's such little inventory that any competition is making it hard for people to enter the market. And even if there's a little less demand on the upper end, there's such little inventory that it is being absorbed quickly. So if you put your home on the market today, the average time from listing that home to selling it is 18 days. That is one of the lowest all-time amounts. That's today. That's with 7% mortgage rates. Could you imagine if rates dropped to 5.5%? And homes that are selling within 30 days represent 76%. So you have to remember that you're never going to get 100% because you always have some crazy people putting it up. I'm going to put it up at this amount, or just unreasonable listings that you're going to see. But it seems to me that anything that is listed at a reasonable price is going, and it's going very, very quickly, even at 7%. There is also a lot of strength that people don't talk about in that 37% of homes are owned free and clear. So those individuals don't have
that high.
Yes, 37%. So they don't experience any pain of giving up a lower rate mortgage. Another thing I see a lot of people doing today, Ed, is if they get the advice of a good mortgage professional, what they're able to do is, the way most people sell their home and buy a home is they say, okay, I'm going to sell it. I've got this cash after I pay off my mortgage. I got my closing costs that I pay the real estate agent. And then I take into consideration the closing costs for the new home. And the rest of this, I'm just going to put down on the new home. Well, a wiser thing to do if you have debt, and a lot of Americans do. Credit cards are all-time high. Car loans have gone sky. There's a lot of debt out there. So put less down on the new home. Pay off all your outside debts, credit cards, car loans, things like that. The payment on the new home, even with the higher interest rate going from, let's say, a 3.5 to a 7, is actually cheaper on a more expensive home with a higher rate when you consolidate debts and you take out a bigger mortgage. So I see a lot of people doing this and using this technique because people just need to get that home. If you've had kids, or you want that, we want to get that nicer place. Typically, we want to make the move. This is a tool that can be used if you have debt to get people in that home.
And people just have to then discipline themselves to not reuse that credit card and rack it up again.
Hard to do.
Yes.
We are, we like what we like, and we want to spend what we want to spend. We might say that it's just harder to do. It's kind of like being on a diet, right? A financial diet's just as hard.
What about the return to work phenomenon? Are you seeing any impact on housing from that? Because we're hearing more and more that larger employers are telling their employees to come back to the office at least a few days a week.
Yeah, for sure, we are seeing that, and the result of that, I think, is having a more difficult effect on commercial properties. It's a double whammy on the commercial side because you're getting, if you own a commercial office building, you might be getting some employees to come back, but you probably could do with less space. So when the lease comes up, you're looking to downsize. So if you're a landlord owning that, you're seeing people saying, hey, I don't need more space. I need less space. I want to downsize. I want to move to someplace, so that's not good. But at the same time, if you're the owner of that property, not only is less revenue coming in, but you are also now experiencing, just similar to what we talked about with Yellow, right? When their debt rolls over, same thing. Commercial properties, your debt's rolling over to significantly higher amounts of monthly payments, so you're getting a double whammy there. I think that's going to impact the way landlords are dealing with this, the way their cash flow is coming in, the way their expenses are going out, and ultimately the value if they try to sell it, because then commercial is a lot easier to appraise than residential is, because on a commercial property, it's like a business. It's just, here's what expected cash flows, here's what expenses are. So I think values of commercial properties are coming down significantly. So that makes it less of an option to pull cash out. That makes it less of an option to refinance. There's a lot less things that you could do on commercial, unfortunately. And I worry that area is one of the things that the Fed is going to break.
Yeah, I have a feeling you're right.
Yeah, I'd look for the job market to give us some clues. Now, it's been unbelievably resilient. The initial jobless claims, I scratch my head when we get these numbers in. But the job market tends to lag. It does tend to lag. And, we have seen this before. Our dear friend David Rosenberg has written and documented how a lot of these lags do take time. And he cited all the previous recessions. It's looked as if, we are in this situation, and then, our dear friend Lacey Hunt, he points out, we may already be in a recession on the income side. When you look at gross domestic income, that has now been contracting. We saw the employment cost index just last week. That was Alan Greenspan's favorite indicator. He put a lot of weight on that, and that dropped to just 1% in the quarter from 1.2%. So we're seeing a lot of signs that the job market is just starting to roll over. I think if the Fed sees that, it's going to be late in the game when they see that because it's such a laggard. But I think that might be the thing that convinces them that, hey, we don't have to get to 2%. Things are really breaking. When they see the job market break, that's when they're going to say we have to stop.
I guess last question, Barry. We live in this great country. You and I both love this country, the United States, and yet it's we love to spend money, right? Our government loves to spend more than it takes in, and we're hearing about how, because of increasing deficits, the government is now going to have to issue over $100 billion in new bonds in the coming months. What kind of an impact do you see on interest rates in general when that starts to happen? Can the market absorb that much bond issuance, that much inventory? And would that also impact mortgage rates?
Yeah, it's going to be a liquidity suck. It should impact stocks as well. And it should impact mortgage rates a bit too. But because most of that paper is shorter term paper that they're issuing, it hasn't had a dramatic effect, although it has certainly been a headwind for mortgage rates. Again, we've seen inflation come down, and I showed you from the peaks where we were. Now, we haven't made as much progress on core PCE. When you see core PCE come from 5.6 to 4.1, it's good progress still. It's not, enormous progress, but you should have seen a similar move lower in mortgage rates, right? You should have seen that. We didn't get that, Ed. And I think part of that is because when we came close to default, you had the Treasury's general account that was used to fund it, and it got all the way down, and now that has to be replenished, and we're now able to sell a lot of bonds into the market. So that's grabbing some of the liquidity, and also some of the paper that's being put out there is forced sales because banks have to raise money. And when you see what's happened to deposits have been fleeing and going into money markets. I have something that kind of depicts that here that'll show you very quickly. It is a chart that I think, picture's worth 1,000 words, right? And if you take a look at this chart right here, you can actually see what has happened in yellow, the deposits really fleeing and going into money markets. Fortunately, this has leveled off. So when we see where we have been in the banking sector, banks were forced to sell some things that they could sell to raise capital. They're not going to take your car loan back and say, hey, you got to repay your car loan. You've got to repay the business loan or home. But what they can do is a lot of their money that was put into mortgage-backed securities, they can sell that to raise capital. So we've seen that come on the market. And the FDIC had the assets that they seized from the three banks that went under, Signature, First Republic, and Security National. Silicon Valley. Pardon me, Silicon Valley. Forgive me for that one. When they had those three big banks' assets, they started selling them and putting them on the marketplace. So what that did is it created a little more competition too, a little bit more liquidity out there, and more selling has pushed rates higher. So it's a combination of all those things you mentioned.
The Rubik's Cube, we continue to try and solve it every week here, Barry. Always appreciate you joining me, man. It's always great to see you. Hope to see you in person soon.
I love watching you. I don't miss an episode. I think you do such a great job, and the guests always bring a lot of value. So I hope I was able to bring some value for you today.
If you want to know how to invest at the end of this interest rate hiking cycle, check out my conversation with Sam Rines of Corbu Research.